to take control again. We enter the trade at the close of the rejection candle, place our stop loss just above its high, and set our take profit at the next major support level. Now look at what happens. As you can see, the market resumes the downtrend and reaches our target as expected. Now let's look at another chart example. This is the euro versus the US dollar on the daily chart. As you can see, the market makes an impulsive move lower, followed by a pullback, and then another impulsive move lower. This confirms that the market is in a clear downtrend. Now let's draw our trend line by connecting the swing highs. Here is the first touch, and here is the second touch. Now let's see what happens next. Price retraces back toward the trend line, gets rejected, and forms a clear bearish engulfing pattern. This is our confirmation to enter the trade. We enter the trade at the close of the bearish engulfing candle, place our stop loss above the recent swing high, and set our take profit at the next major support level. Now look at what happens. As you can see, the market resumes the downtrend and reaches our target as expected. Now, let me tell you something important. If two traders use exactly the same trendline pullback strategy, one of them may consistently make money while the other keeps losing. So, what's the difference? The difference isn't the strategy, it's how they execute it. The profitable trader avoids a few critical mistakes that most beginners make, while the losing trader repeats them over and over again. Let's look at the 4 mistakes that can completely ruin this strategy. One of the biggest mistakes beginners make is forcing a trend line to fit the price. As you can see here, we have a clear uptrend. This is the first touch, and this is the second touch. By connecting these two swing lows, we get a valid trend line. The mistake many traders make is trying to force the trend line to connect the third touch. As you can see, doing so changes the angle of the trend line and causes it to ignore the previous swing lows that the market clearly respected. Remember, the market defines the trend line, not you. If you have to keep adjusting the line just to make it fit every new swing, it's probably not a valid trend line. If there isn't a clear and obvious trend line, simply move on to another chart. There will always be another trading opportunity. Another common mistake is entering the trade as soon as price touches the trend line. Just because the market reaches the trend line doesn't mean it will respect it. Sometimes, price breaks straight through the trend line and continues moving against you. That's why you should always wait for a confirmation candle before entering the trade. As you can see on this chart, price pulls back to the trend line, but instead of buying immediately, we wait for a bullish confirmation candle. Once the confirmation candle closes, we enter the trade with much greater confidence that buyers have stepped back into the market. The same principle applies to bearish setups. Wait for a bearish confirmation candle